Gold has long been seen as a safe haven for investors, holding its value through turbulent economic times. But the precious metal has had a rough few weeks, now trading down 13% so far this year. It's got some questioning whether gold really should be viewed as the insurance policy some have seen it. David Kaufman is president of Westcourt Capital. Great to see you.
Good to be back. Thank you.
It does raise that question because we know that these kinds of commodities can be volatile, so we expect it to be volatile, but it's being volatile at a time when the world is still volatile, and it's supposed to be doing the opposite. It should be the safe haven. What's going on?
Yeah, it's sort of like just when you need your friend the most, they abandon you. You know, gold can be, it's meant to be a store of value. It always has been a store of value, which makes sense. You know, they say that even in Roman times, an ounce of gold would more or less buy a man's suit or toga or whatever it was. Yeah. And that kind of held true until the 80s and 90s when gold went on this crazy run where it became this magical investment that always went up in value. And even if you don't buy that, in the last number of years, advisors are always saying, and people, you know, all the gold bugs always say, you need to own gold in case the markets plummet. And in other words, insurance, as you said. Yep. And if that were true, that would be great because, you know, bonds may be a bit of a ballast to equities, but they don't always work. And so you should have this other insurance policy in your back pocket for when the rain becomes a flood. And unfortunately, if we look at the numbers, you know, it just isn't true.
David, how would you push back against those who point to the big macro trend right now, which is the massive intervention of central banks around the world, the printing of money, quantitative easing, people saying this is inevitably going to lead to inflation, and gold is that hedge?
It may be that gold will be, it is a hedge against that kind of inflation, but the first thing is, you know, they say that you can't fight the Fed, and you can wait a very long time to require that kind of insurance. And along the way, you might need insurance against, you know, a precipitous fall in, for example, the equity markets, which could precede inflation by months, if not years. And at that time, you might find yourself without that friend when you need him the most.
How does gold do historically in turbulent economic times? I think you've got some illustrative examples.
I do. I took a look at 3 years, at 2008, which we all remember as the financial crisis, at 2011 when we had, you know, a fiscal cliff part one, and then this year where, you know, the markets have started the year really well, and then we had some issues in April. And if you look at 2008, especially in October, where the TSX was down 17%, not so great. Well, guess what? Gold was down 20% that month. So not only did it not make it better, it actually dragged you down and made it worse. Same thing, September 2011, a terrible month in the markets, TSX down 9% just for that month, gold down 11%. And I don't have to remind anyone what happened last month. The TSX was down a seemingly paltry 1.7%, gold down 7.7%. But it's not just about the numbers, it's about the theory. It's about the idea that is when the world is supposed to say, as we come closer to the edge of the precipice, and as the world is falling apart, you know, I want some gold, I want guns and ammunition. And the bottom line is that I don't think that the world thinks quite that way when the markets are tumbling.
Well, a little canned food would help also. But look at 2008, gold drops off. Is that because people are selling gold to cover equity positions, and then we saw gold march on from 2008, you know, hitting new highs as recently as a few months ago?
That's a very good question. And the short answer is people will sell whatever they can when they need to raise capital. And in retrospect, it's somewhat easy to make the call why things happen, but it's predicting them that is more important than calling it after the fact.
Just seconds here, but we are told to keep some gold in our portfolio, 5%, some people say. Why is that if it's not a great store?
I don't agree with that, but in the event that you're going to do it, 5% at least isn't going to hurt you that much because you lose, you know, 10% of 5%, you're still left with 4.5%.
So you would say you don't need any gold in your portfolio whatsoever?
I think gold is speculative, and it's great for traders, but I don't think it's the greatest investment.
Always good to have you, David.
Good to be here.
David Kaufman, president of Westcourt Capital.